So today's Cardinal lesson really results from an example. A gentleman called me. He's been with us for several years. We've been doing Roth conversions every year, and it's that time of year that he is filing his taxes. So he's in communication with his CPA, and his CPA is telling him you're going to have a bunch of taxes to pay because you're doing these Roth conversions and all this other kind of stuff. And so now he's raising cash by selling stock, substantially appreciated stock, and he's figured out that he's going to have about 150,000 in capital gains. And he has a question for me was, how much tax am I going to pay? How much do I need to get ready to pay? And my answer was, well, it depends. And so I told him I'd get back with him. I guessed at about 15% of one tax. There's several others. And so I haven't gotten back with him yet, but I thought this would be a great show. It's a dilemma because he's been doing these tax calculations every year. We normally do it in November and December, but we haven't paid much in capital gains taxes. He hasn't, but he's starting to, and he kind of wanted a little advanced stuff in February. Yeah, I just thought it'd be beneficial to just show the world this. So, Tom, why are we doing this video today?
Yeah, I mean, we're doing this video because tax planning is complicated, right? I mean, you have a lot of moving parts, you have a lot of different taxes to consider, and they all interact with each other in different ways. And so when you sit down and try to do this yourself, you end up either overestimating your taxes or underestimating your taxes, which is not great, right? Because at the end of the day, when you're selling things, you're generating taxes, you need to know how much of it you can keep. Because if you spend it and then owe this big tax bill later on, that could be a problem. So we do a lot of this in our practice. We do a lot of tax planning with clients. And so we just wanted to give you guys a real world example of what this looks like, how we approach it from a planning perspective, and what it means at the end of the day for him, how much he's going to pay, or you, like you can sort of put yourself here. Now, this show is very specific to a one specific example, so it might not be relevant to you. But if you have questions, let us know. This is stuff we do every day. So let me bring up the show notes. You can find these below our link on our video here. You can also find them on our website at cardinalguide.com. It's the board. Granted, the board is pretty busy today. When we're going through it, we'll walk you through what we're looking at here. So you're probably going to want to print this one out. If you're trying to look at this like on your phone or something, it's going to be hard to read. So print it out. Go look at it if you really want to look at the numbers. The subsequent pages in the show notes are really the different tax tables. So this particular client is in California. So we got the California state tax rates. We got our IRMA, which we'll get to in the video. This is the extra amount he's got to pay for Medicare because that's a factor. We got the net investment income tax. So again, that we'll talk about more of that in the video as we go. These are your ordinary income tax brackets 2026. That also gets into the capital gains rates because he's incurring some of that. So again, we'll go through the video. We'll give you the examples, but we have a lot of different taxes we got to consider and how this impacts him. So Hans, why don't we get us started? We'll just get going here.
Okay, so what we've done with this fellow, with Roth, really is Roth conversion. We've done a bunch of other planning, but when we're getting the tax charts out, it's pretty much been this one, which you've seen in several of our videos, which are just the tax brackets in 2026. And, you know, what he's doing around his Roth conversions is, with him, like most people, we were trying to get up around this number of 403,000 or not violate that. So we can keep him in the 24% bracket. And then we had to add on, we haven't shown you this, for him in California, an additional 10% he's got to send to the state of that, building up that Roth conversion. So now he's throwing in a new thing in the equation. He's saying, I got to sell some stock. I'm going to net gain about 150 grand. How much tax is that going to cost? And the reason he needs the 150 grand is he's got to pay the taxes on the Roth conversion we did last year. Just that simple. I mean, he's going to have to send those in, and he wants an answer. And so the fast answer is you're going to pay down here in the capital gains tax rate. It's going to be all in the 15% bracket because you're not going to be over 613 grand, I don't think. So it's going to be 15% in capital gains tax. And that all of a sudden sounds pretty good. Um, but there's more. He's going to have to pay. There is no capital gains tax rate in California, and most state income taxes don't have one. California's is higher than most. Some states don't even have a state income tax, but for his purposes, it's around 10 to 11% on top of the 15%. So now we're at like 25. Okay. And we're not done yet because he's also going to be subject to this NIIT, the net investment income tax. And we're not going to attempt to teach you the whole NIIT today, but if we put part of it up there, we got to put all of it up there, and that's why the board is so busy. And so in his case, he's going to pay 3.8% on that whole 150 grand of capital gains. So he's going to be up 29%, approaching 30% on that 150 grand that he's adding to his income by selling those stocks. Okay. And so that's his answer. But I have to give some qualification because I can't just take care of this all in one phone call. Tom and I needed to get out all of these charts, at least in our head, and get them out and, calculate them. And it just, because that just gives his answer to his one question: how much tax am I going to pay on this 150 grand? And what I told him on the phone call is what's really at issue is how much are you going to convert in 2026 to a Roth conversion. I told him it's not going to be 290 grand. More than likely, if you have the same 200,000 of basic income, which is mostly passive rental income. Okay, so you're going to have that. And then you're going to have this 150 grand coming from the capital gain. So now we're up to 350. And the reason he's finished at 490 for 2025 when we were planning all this stuff is we stayed under the $500,000 SALT. And, SALT is state and local taxes. So a bunch of stuff in the tax bill, in July last year. And what it amounts to is it's very important to this guy that he gets the full $40,000 deduction to put with some mortgage interest to get his deductions up to like 88,000. That was part of the reason we went to 490 of conversion, of total income, part of that being a conversion. Last year, we stayed under the 500, but we also, by the time he took his deductions, he kept himself for the most part in the 24% federal bracket. So if I got you singing in circles, that was the whole point of the video, is not to teach you all this stuff, to really just kind of show you the drill that we go through. And when we get onto it in a second, I want to walk you through the whole board and show you what's in each section. I want Tom to just kind of jump in and give a little reaction to everything I've just told you.
Yeah, I mean, I think as Hans was going, you can see that it's complicated, right? A lot of these things are interacting with each other. I mean, you think a little bit on that net investment income tax, that additional 3.8%. One of the things that's tricky about that is not all your income is subject to that, right? Which is a good thing, right? If you have income that's not, but if you have things like capital gains or interest or rental income, those type of passive rental income, to be specific, those type of things are subject to an additional 3.8%. So you got to add that back in there. And again, the limits to get to that is for a couple 250,000, but all of your income goes towards that calculation, right? So if you have a bunch of IRA distributions that put you at 250,000, and then we have additional income above that, that brings in more. So again, when we get through the example, I'll bring it up and we'll actually walk through that Excel file I've used in the past to do examples. I'll show you how it all relates. But again, there's a lot of moving parts here. We're focused on the SALT deduction, right? Trying to keep his total income below the 500 so he can claim that 40,000 of deductions on his tax return, which will be important, especially in a high income state tax like California. So we got to keep an eye on that. We got to keep an eye on the impact on IRMA, the increased cost of Medicare. I mean, there's just a lot of things And if you don't do this for a living and you're trying to sit here and figure this out, you're going to miss something, right? You're going to make a mistake and you're going to end up either probably paying more than you think you ought to or than you had to because you've just missed one piece of it that's important to know. So when he comes with a simple question, how much tax do I owe? The answer is a much more complicated answer because again, we got a lot of moving parts here.
Okay. So you look at the board, you got federal ordinary income tax. And this is normally what we're using when doing tax planning. We look at these are right in front of us all the time. We reach a point where we get these numbers memorized in our work. But you have those, that's ordinary income tax. Then what we're showing here is the capital gains tax, married and single. And in his case, he's in this bracket right here, which is the 15% bracket. And so depending on people with other questions, we could spread stuff into multiple years to worry about some thresholds. But ordinary income tax, capital gains at the federal level, then you got your state income tax, which we can look up your state too, and we do when we're doing planning for you, of how the brackets work on that. And well, as I said, most states don't have a capital gains tax. It all falls under the same number. And then we've brought in the net investment income tax, and that came with a whole bottom half of the board because the net investment income tax counts all your income to violate the threshold or to reach the threshold. So in his case, he's going to be at 490 again, I think. Um, and so it's clearly over the 250, but he's not going to pay the 3.8% additional tax on all the 490 of income because a good bit of the 490 of income falls, it's not under the investment income tax, only the part that's actually considered investment income. Like I said, this stuff is complicated. And I wrote in at the very end, there's three more factors besides that. We got one, two, three, four separate taxes that we're doing. And then we go up here, we got IRMA to look at. We got the Social Security, the income tax on Social Security, which in his case, he hadn't started it yet. But, and then we have to look at the threshold of 500,000 for state and local taxes. So that adds the number up to 7 factors with all different thresholds moving around. And didn't make this video to confuse you, nor am I going to drill into the weeds and get into all this stuff. I just wanted to lay out the dilemma, and then to give him his answer and to make decisions, Tom is going to put this stuff into his planning software. And let's do this quickly, Tom, but it's just go through kind of all those numbers and let's kind of arrive at what his taxes are going to be.
Sure. So yeah, so let me try to make this. I'm not going to go through every page and look at everything, just because again, ultimately, you just really want to know what is the total number. But just to walk you guys through real quickly, I put in, this isn't their exact date of birth, but he's 68. His wife is 58. So we put those ages in there. They're married, filing jointly, right? Just how they're filing their taxes. We have 140,000 out of the IRA. This, in his situation, is Roth conversions. The net taxes work the same way if you just make those in a living off the 140, but one way or another, he's pulling 140,000 out of his Roth conversion. We have 150,000 of capital gains. So, in the example, I have proceeds of 300,000, a basis of 150. So the gain is 150,000 he's taxed on. And then he has 200,000 roughly of rental income, right? So all of that gets added together. So when we add all those numbers together, a total income of 490. Again, this was done intentionally to stay below the 500 threshold to be able to claim the full SALT deduction, the 40,000 of state and local taxes. So we have the gross total income of 490. That 490 exceeds the 250 threshold for that net investment income tax. So some of this tax is subject to that 3.8%. I'll talk about that in a second. He's itemizing deductions, right? Because we have the 40,000 of state and local taxes. He has another about 44,000 or 48,000 of home mortgage interest. He's got a pretty big property out there that he's able to claim interest on that. So that gets added up to 88,000. So our total taxable income is 402. We go through and we look at his total sort of tax. This is without the net investment income tax, is about 68,000. And then this is where this other tax line, this is the net investment income tax, that additional 3.8% that he's having to pay on. That's an additional 9,120 on those taxes. So federal taxes all in, he's looking at about 77,296. Again, if your numbers are different, then obviously the tax would be different. But that's what he's looking at when we think about sort of what kind of percentage that is. If we take the 77,296 and we divide that by 490, so he's got a gross income of 490,000. He's paying 77,000 of tax. He's right at that sort of just over 15% tax rate. So it's really not that bad. He's got a lot of income. It's not that bad, even with that net investment income tax. A lot of that is because he's able to take this higher deduction, right? He's taking more than the standard deduction. That helps reduce some of the taxes owed. But it is very, it's helpful for him, right? And this is what, from a planning perspective, if you're a little bit younger and you're thinking about retirement, this is why it's helpful to have choice in different money in different buckets that are taxed differently, right? He can pick and choose. Am I pulling it out of the IRA? Am I incurring capital gains? If he needs extra money, we don't want to exceed these thresholds, he could pull money out of the Roth if he needed extra money. So he's got choice of where this comes from. So he can really dial in sort of that tax rate that he's willing to pay or comfortable paying moving forward. The video, we're not going to necessarily get into the state tax calculations, but you could look at the show notes or the board.
We kind of did that. It's about 65 grand. So it's kind of interesting that his state income tax in California is going to be approaching his federal tax. It's 65 grand. It's about 10% or so of his overall 490 of income. Well, it's more than 10%. Anyway, he's going to be happy with this answer at the federal level. And I mean, that's really what the video is about. Now, how do we position this in comprehensive retirement planning, which we've been doing for him for several years? We could do for you. I mean, this whole show has been about taxes, and it's about all the different taxes bouncing against each other. It hasn't really been much about estate. It is all about income, because he's got to have some money to spend and live off of out of this whole thing. That's the purpose behind it. It's been about 401k and IRA, because we're trying to get his money out of traditional into Roth, but we're trying to do it strategically and smart. It hasn't been about long-term care, and it has been a little bit about Social Security, other than that's one of the taxes that we got to think about. And really it's been about Medicare, because we haven't really talked about IRMA for him. But it's a good point just to finish on, is some people, once they learn about IRMA, they start doing all their planning around IRMA. And IRMA is just a drop in the bucket compared to all the other taxes that he has to deal with. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.